as I said, I'm going to try to give a complementary perspective on the U.S. outlook to that of Karen's. I do need shorter microphones. The reason for this is because there is a logic here. As Karen mentioned, forecasting, macro forecasting, is really about pattern recognition. And what I want to say is that there was a pattern already evident in the fall to what the Trump administration's economic policy approach would be. This had very clear implications, and this is what's turning out so far to be the case. And when you look at it from that perspective, you get a different macroeconomic forecast, one that is essentially much more inflationary, much worse for growth in the both short and medium term, and one which is not going to go away anytime soon. And part of the point of this is there is so much chatter, not among the wise people here, or let alone my colleagues, but so much chatter in the markets and the press about who's up, who's down in this administration, which side of the bed the president got up on this day, what does Vietnam or Mexico or Canada bring to the table, all of which is important, but is ultimately secondary. What we are undergoing is a fundamental shift in the regime of US economic policy. And by regime, I mean it in the political economy sense, the ongoing set of norms, institutions, practices that define a situation. And so the bottom line is we may get recession, we may not, but you're going to get inflation either way. And that it can happen here. The US economic governance can go fundamentally wrong. So I put up a clip from an article I published in Foreign Affairs in October, in which I talked about the true dangers of Trump's economic plans. And what I argued in that article was that there were two major commitments of the Trump administration incoming, if they came in, that would be destructive. First, the efforts to close off the US economy, and second, the deliberate choice to weaponize uncertainty in its relations with other countries. And my point was, not only would these reduce real income, but that these should be seen as creating negative supply shocks. And I bring up what I said not to say I told you so, because frankly, while the world's going to heck, I told you so is very small comfort. I bring it up to make the point most of this was predictable. There is a logic here. This is not just the accumulation of temporary chaos. This was by bad design. And so, in theory, in such a situation, and this is something officials in the Trump administration have said, in theory, this doesn't have to result in inflation. You're having a reallocation effect. You have a cutback in real incomes. And if the central bank holds the line, and everyone believes the central bank holds the line, you have a real adjustment. And economic historians, or people familiar with economic history, will remember that this was essentially what Britain did during the Great Slump in the 1920s, or what Andrew Mellon and Herbert Hoover wanted in the 30s, which is to say, suck it up, adjust, get over it. And if that were to happen, it's true, that would not be inflationary. That's how you end up with things like the Great Slump, the Great Depression. But in practice, that's not how things usually go, because you don't usually have a government or even a central bank that can ignore that going on in a democracy, and particularly when you have an unstable regime. And so what happens is things that used to be true in the US are now reversed. One could say it looks more like an emerging market. I don't like saying that because it's lazy and makes things too simple. What's happening is the quality of economic policy regime is shifting to one where the relationships are reversed. So one example, of course, would be what we saw in the Treasury markets last week. It's, as Karen indicated, it's not self-evident what happened, but it is at least consistent that if you were looking for a shift in how people think about the US economic regime, a period of stress when the currency goes down at the same time interest rates go up would be a reversal of normal patterns. We have a situation where there, as I will discuss, going to be shortages of various goods and services, and these will feed, rather than market adjustments, these will feed protectionism, which will feed subsidies, which will feed further shortages. It's a situation where the allies, and this goes to some of the work Jacob has been doing, instead of insuring themselves by putting more money in the US, will insure themselves by self-insuring and relying less on the US. And it is a situation, critically for the short-term forecast, where attempts to do macro stabilization will result in more inflation rather than less. This is forecastable, and this is where we are. So, oops, thank you. So this is my chart, as opposed to, say, Karen's or our colleague Warwick McKibben's much more sophisticated charts. This is a histogram of the likely outcomes of growth in my forecast for the US economy. So the y-axis is the risk of a particular growth rate, and then you have the growth rate by quarters, points. This is meant to be essentially the average over the next 2 years. First point is, if we define a recession as averaging for an extended period negative growth, recession risk is 65%. That's a very high number. Second point is, there's a fat tail to the right, to the positive side, and the reason there's a fat tail is because we don't know what fiscal policy is going to be. If they really do just pass the 2017 tax cut extensions with very little else, and they cut back Medicaid, and they get a lot of revenues from tariffs, which is essentially the baseline you have to look at. As Karen says, that is probably net zero or slightly negative fiscal impulse. I do not believe that's going to be the case. I do not believe that they will stop at just the 2017 tax cut extension. I do not believe that the spending cuts are going to materialize, except possibly for Medicaid. I do not believe the revenues from tariffs are going to be as high as they say. And I do believe that there is a chance, particularly if we start getting negative growth, that the president and the Republican majority in Congress will say, well, we had a good time mailing out checks in 2000 with a big Donald J. Trump signature on it. Let's send everybody a $1,000 check. So in my view, I don't know what fiscal policy is going to be. So it could be even as high, say 5 or 10% chance you could get above 1% growth, but only if there is a very large, irresponsibly large fiscal stimulus. And otherwise, I'm very much with Karen for reasons that I'll go into and others are saying, you're not going to get a big consumer bounce. You're not going to get a corporate investment bounce. In fact, you're more likely to see a cutback in corporate investment. So and you're not getting net exports. So the only way you get growth is if you get a large government stimulus. Now, the upshot of this, as I said, is that while there's that range of growth outcomes in my forecast, inflation is actually much more range bound. That inflation is going to be higher even if we get the recession. In other words, we're going to have stagflation. Why is this? Because ultimately, the Fed is too complacent about the anchoring of inflation expectations. It's not a disaster. It is a bit of a contradiction to many of the people in the Trump administration or advising the Trump administration, or even potential candidates for the next Fed chair from the Trump administration, spent part of the fall talking about how the Fed had been irresponsible and led to inflation, but now say that inflation expectations will be anchored and none of this is going to get passed through. None of the tariffs and other things are going to get passed through. None of the currency weakness is going to get passed through. That is a contradiction. And while I think these people who were critical of the Fed exaggerated their case in the fall, they had a point. It is wrong to think that inflation expectations are as anchored now as they were before 2020. That is simply not credible. If we think about what happened in 1982 versus 1985, when Paul Volcker was doing the disinflations, the same inflation and shock in 1985 led to a bigger response because inflation expectations had not been brought down fully in 1982. Secondly, the Fed is already too loose. Some of you have heard me make arguments about this. Karen mentioned in the jargon, and correctly, that the R-star, meaning the neutral rate for the economy, is probably significantly higher than the Fed thinks it is, meaning the monetary policy right now is looser than the Fed thinks it is. We've had a number of events, and I and others have spoken, Olivier Blanchard, Larry Summers, Maury Obstfeld, Karen, about why R-star may be higher. But anyway, so monetary policy is not as big. But let me just go forward a second. If you look at the left chart, this to me, if I have to pick one variable to define monetary conditions, it's this, which is the spread on corporate yields on B-level corporate bonds to 10-year treasuries. And what you see is, even with a slight spike in the last few weeks, the spread is well below levels of most of the last 10 to 15 years. So even though the Fed raised interest rates by 550 basis points, financial conditions have not actually tightened. You could also look at mortgage rates, real mortgage rates. You could also look at credit default rates. You could also look at money supply. There are a whole bunch of things you can look at. This is only one of them. But it tells you that people who say, as Fed officials do, that we're already in restrictive territory, I think are overselling it. And so that makes the point even more pertinent that if we get inflation, the Fed will be behind the curve. And then there are political economy reasons why they would be behind the curve. Then, as I mentioned, it is only reasonable to assume that if we get an obvious recession, fiscal policy will loosen. Moreover, there are structural things going on. Chad and his colleagues and our colleagues have spoken a lot about this, but all the talk from the Trump administration officials and some market observers that pass-through from the tariffs to inflation are going to be low, I think is a bad bet. One point is, as Chad already said, all the evidence from last time is maybe it didn't all go through to consumer inflation, but almost none of it, close to zero, was paid by foreigners. It was paid by American companies, the importers. But even more so this time, if we are having deregulation, if we are having mergers and acquisitions and increasing concentration because we don't have the policies of the Biden FTC, if we have discretionary implementation of antitrust and other things that allow for more corporate concentration, if we have exemptions to incumbent companies that get behind tariff walls and get protection, all of those give more pricing power to the companies that are here. You can argue those are good things or necessary things or corrections to Biden excess, but you cannot argue that they do not increase the ability of companies to mark up their prices. So I take the over on what Chad already said, that we are likely to see more rather than less pass-through of the inflation in this period. The most important point is the nature of this new regime. A lot of talk is this is transitional. Okay, they're doing 90 days. Companies will reassess. They'll renegotiate with Europe. They'll be peaceful. Maybe China won't be done, but they'll do okay with Mexico. All of which does matter, but for macro, it does not. Because this is not a transitional state. The uncertainty, the fundamental shift in uncertainty is there and will remain so. I'm going to make an analogy to Brexit. During Brexit, I was part of the public debate. And various people, including people who are opposed to Brexit, as well as those advocating it, would say, the problem with Brexit is we're just so uncertain. We don't know whether it's going to be hard or soft Brexit. Jacob did a lot of work on this. This is where there's going to be negotiations with the EU, how it's going to go, how it's going to be implemented. And I kept saying, the problem with Brexit isn't the transitional uncertainty. The problem with Brexit is Brexit. That you're going to have ongoing uncertainty because it's closing off the economy and changing the relationship with your biggest trading partner. And so fundamentally, you're going to have ongoing uncertainty. And if you look at the chart on the right here, this is a measure of uncertainty for the UK. And what you see is to the right of 2016, you're essentially in a range double the measure of uncertainty that you were before, leaving aside the financial crisis, obviously. And this is ongoing. And I could have put up a similar chart showing corporate investment in the UK, that it has been flat since 2016, which is what you would expect if you've had a fundamental degrading of regime and a fundamental reduction of efficiency and a fundamental increase in uncertainty. Will the US suffer like UK did under Brexit? No. Will the US regime change we are undergoing cause similar persistent rises in uncertainty and therefore almost certainly flattening of investment? Yes. The other aspect in terms of why inflation and why the short-term outcome is going to be grim is because of macroeconomically relevant shortages. People have begun to speak about this. Karen very importantly highlighted the issue of reduced labor coming in through immigration, both legal and undocumented. And our colleagues, Marcus Nolan, Warwick McKibben, and Megan Hogan have done work on this, modeling this. But I want to just emphasize one fundamental channel of many, which is we already have a problem in housing supply in the US, that we don't build enough housing and there's excess demand and prices are going up. Housing supply elasticity is going to decline because we're going to get supply shocks specifically to housing. First, we're not going to get Canadian lumber and other materials, at least not at the same price we've been getting it. Second, Asian, read China, sourced inputs to residential housing, including the 80% of air conditioning units that are built in China, for example, are not going to be cheap. Now, again, this isn't quite like rare earths or pharmaceuticals. There are other sources. Things can be expanded, less so for Canadian lumber than Chinese air conditioning. But it is an upward price shock. Second, as Karen pointed out, and as our colleagues have worked on, and Michael Clemens has commented on as well, in residential construction in the US, except for large apartment buildings, roughly 50% or more of the workforce is migrant labor, much of it undocumented. You're cutting off the skilled workers. And again, you can say it's worth it, you have to do it, fine. Not really, but okay. But from an economic forecasting point of view, this is a supply shock that you're not going to be able to substitute for in any finite length of time. Even wonderful unemployed, non-existent unemployed manufacturing workers in our full employment economy cannot be converted to construction workers overnight. Third, going to the deregulatory side, there are tales that as part of the attempt to privatize Fannie and Freddie as a way station, they are likely to reduce the ceiling of level of mortgages that can be backed by Fannie and Freddie, essentially reducing liquidity and availability of mortgage money for a large segment of the housing market. So in addition to everything at the macro level that Karen was talking about, in addition to the direct tariff effects that Chad was talking about, you should be looking for a stagflationary shock and shortage in the US housing market. Finally, DOGE. As Karen mentioned, and I want to emphasize, although it's very hard to get numbers on this, DOGE has done crazy things. And again, it has to do with the governance and the process, not necessarily what they were doing. So I think it's terrible they shut down USAID. I think it's a little less terrible but bad that they shut down the US Department of Education. But we knew they were going to do that. And if the Republican majority, if the Trump administration had decided through legal measures to say those two departments we don't like, we're putting a bill in Congress that in next year's budget, those will be zeroed out, that would be one thing. Might not be good, but it would be of trivial economic significance. If DOGE says we're going to create a miasma of uncertainty over all US government employees, all hiring, all senior officials, and we're making it so that most American government contractors are not getting paid for last year's contracts and don't know whether they're getting next year's contracts, that has ramifications throughout the whole economy. So it's not about the number, which as Karen pointed out is a very small number. And what happens is we've got some specialized public services like FAA traffic controllers, people who run nuclear plants, civil engineers for specialized infrastructure, public health officials who maintain certain kinds of hospitals and medical services who cannot be replaced in any short amount of time. So this is like being in India where there are power cuts. We're essentially going to have less dependable, less available key infrastructure because of DOGE, and that is a price shock, a negative supply shock. So, bottom line, it can happen here. Self-inflicted policy wounds do create negative feedback loops. The way it's going to show up in the short-term forecast is inflation, whatever the growth outlook is, but likely stagflation. This will lead, as I concluded my Foreign Affairs article in October, to macroeconomic costs of generating uncertainty that outweigh any gains from hardball trade negotiations. And this is radically different from any economic program pursued by either major US political party during the past half century. They tried to weaponize uncertainty. They're trying to withdraw the US from the world economy, and the damage to the United States will be difficult to reverse. It was, however, predictable. So see the broad pattern. Don't get caught up in the day-to-day, and realize it's going to be the work of several years to get it back. Thank you very much.